So today we're going to go through chapter 3 in managerial accounting. In chapter 3, we talk about a system design, job order costing system. So that is one of the systems we need to understand for chapter 3 and chapter 4. Now in this chapter, what we're learning, we are learning to know the differences between process costing and job order costing. And then we need to describe the key decision management must make when applying a system to determine the cost. And also have a differences between absorption and variable costing and between the normal and the actual costing. We're also going to talk about how to compute the predetermined overhead rates. And we're going to use those rates to apply the overhead to the specific job. So this is the predetermined calculation for overhead rates will be the most important parts you want to understand, or you want to read the book carefully, because a bunch of journal entries, T account are closely related to this. Then we will talk about the concept of a clearing account. So we will see if there is a over-applied or under-applied overhead costs. Then we need to understand how to prepare a schedule of cost of goods manufactured and cost of goods sold. We have learned how to calculate your cost of goods manufactured and the differences between the cost of goods manufactured and cost of goods sold. Now, we're going to go to the first one. The purpose of costing system. Managers need to assign costs to products to facilitate external financial reporting and internal decision making. So this chapter illustrates an absorption costing approach. Also we call it is a full cost approach for calculating product cost. We know as a job order costing. Process and job order costing. This is two costing systems are very commonly used in manufacturing and many services company. So we understand there's two different systems, process costing and job order costing. Okay. Now, so this is the a costing system should be tell you which costs are traceable to the cost objects, or tell you how to allocate costs that are not traceable to the cost object. So that is overhead cost, right? So in this point, can you remember about the differences concepts of fixed and variable manufacturing cost? The meaning, so I just wanted to emphasize again, the total fixed costs are constant. We have talked about this yesterday. The total fixed costs are constant, and therefore change on a per unit basis. Variable costs are proportional to the number of units produced and are constant on a per unit basis. So those we fully understand those definitions. Then we move on to the two different costing system. The job order costing system. This type of system is used when many different products are produced in each period. Products are manufactured to order. The unique nature of each order requires tracing or allocating costs to each job and maintaining cost records for each job. Examples including use the job order costing, including Bombardier, that is the aircraft manufacturing in United States, and or Hallmark, that is for greeting cards maker. Process costing system is different. Okay, this type of system is used when a company produces many units of a single product. One unit of products is indistinguishable from other units of product. The identical nature of each unit of product enables assigning the same average cost per unit. The examples including Coca-Cola is a mixing and bottling beverage. They just produce the similar products. Okay. The process costing, we're going to cover it in the chapter 4. So for today, we basically talk about job order costing. So this is the example. So we're just used, also can used in service industry like hospitals or law firms. We're going to talk about this in a later. Now, comparing the process costing and job order costing. With job order costing, many jobs are worked on during the period. With process costing, a single product is produced for a long period of time. With job order costing, costs are accumulated by individual jobs. With process costing, costs are accumulated by departments. So those are the very big differences, and then there's the other one. The job order costing, average unit costs are computed by job. The process costing, the average unit costs are computed for a particular operation or by department. Right? So clarify the differences between process and job order costing. Contrast a company manufacturing standard metal desk with a company manufacturing costume-made hardwood desk. So you can figure out which company would probably use the process costing and which company would probably use the job order costing. The costume-made, because every desk they'll be making are different, right? So we have to use the job order costing. But the normal standard metal desks will be used process and costing because they're just single similar units. Now, when we move on to the key management decisions, absorption versus variable costing, normal and actual as well. So the absorption costing, including both fixed and variable costs, were used to determine profitability of products. Common in many business, required for actual financial report and tax report. Variable costing, including only the variable costs. It used when management wants to determine the additional cost of actual units of product. Fixed costs are not relevant, so are not considered about the fixed costs. Will be examined in later chapters, so we'll talk about it later. Now, normal costing and actual costing. Normal, if managers allocate actual manufacturing overhead cost to the products, they're said to be using the actual costing system. If the manager used the budgeted manufacturing overhead cost and apply them to the product, they're said to be using a normal costing system. Managers must decide whether to use a normal costing system or the actual costing system. But in our textbook, chapter 3, we basically talk about the normal costing system. So we have to learn the predetermined rate and allocate all those predetermined overhead costs into the real products. Okay. Job order costing. The type of manufacturing costs. Right there. So we determine the cost of a specific job in a job order costing system. The type of manufacturing costs that are assigned to products using a job order costing system. We see the direct costs, including direct materials, direct labor. Those are traced directly to each job as the work is performed. Then the manufacturing overhead, including indirect materials and indirect labor. Those costs are allocated to jobs rather than direct traced to each job. Okay, so that's why we said apply to each job using a predetermined rate. Now this is a sequence of events in a job order costing system. We can see that from the direct material and direct labors are directly goes to each job, right? You can very easy to traceable. For manufacturing overhead is untraceable. So that's why we learn the calculation. So this is applied overhead to each job using predetermined rate. And then you can easily assign the overhead cost to each job, number 1, 2, 3. Now, the application of overhead. Overhead must be included on the job cost sheet, since the overhead is a cost of the job. However, determine the amount of overhead a specific job consumes is difficult because it's not traceable. So overhead is an indirect cost. Overhead consists of many different items. Output may fluctuate, but overhead tends to remain relatively constant due to fixed costs. Our textbook has showed, I still wanted to make sure that in our textbook, for easier tracing, for direct material and direct labor, you will see those two forms. One is material requisition form, another is the employee timesheets. So those are the forms to show you how you're going to trace the specific material and specific labor cost into a specific job. Okay, so overhead is a difference. That's the one we are talking about. Now, when we talk about predetermined rate, we need to talk about a allocation base. Oh. So if we wait until the end of the period, no, I want to go through this one first. So the need for predetermined manufacturing overhead rate, we use a predetermined rate make it possible to estimate total job cost sooner. Actual overhead for the period is not known until the end of the period. So you will know the actual overhead costs, but it's not just it's not at the beginning of the job started. It will be the end of the period. So what we always do is, if we wait till the end of the period, we will know the actual total overhead cost. However, still we won't know the actual overhead cost of a particular job. Why? Because overhead consists of costs that are either difficult or impossible to trace to particular jobs. Difficult to trace costs include the cost of indirect materials like the glue in a furniture factory. So you cannot say if you have a multiple work started, like you have to do make a desk and then make a chair and you use the glue. So you have no idea how much glue is being used in the chair or in the desk, right? Then impossible to trace costs include fixed common costs like the property tax on factory buildings and land. So then we talk about allocation basis. The allocation base, such as a direct labor hour, direct labor dollars, or machine hours, is used to assign manufacturing overhead to products. Allocation bases are used because it is impossible or difficult to trace this cost to a particular job. Manufacturing overhead consists of many different items, range from the grease used in machine to the product manager's salary. Many types of manufacturing overhead costs are fixed, even though output may fluctuate during the year. So the predetermined overhead rate is calculated by dividing the estimated amount of manufacturing overhead for the coming period by the estimated quantity of the allocation base for the coming period. Ideally, the allocation base chosen should be the cost driver of overhead cost. So that's what we talk about in there. A cost driver is a factor that costs the overhead costs. Examples including about cost drivers, machine hours, direct labor hours, machine maintenance hours. Basically, in our practices, you will see a lot of questions from our textbook or from your homework. Machine hours and direct labor hours are most commonly being used as a cost driver. So the base, now this is a calculation. I want you to read it through very carefully. Okay. Manufacturing overhead is applied to job. Use the predetermined overhead rate multiplied by the actual amount of the allocation base using completed the job. This is called a normal costing system. For example, we will have examples. I don't know if we have examples in our slides. Oh, we do. Okay, so you will see that the predetermined overhead rate equals the estimate total manufacturing overhead cost for the coming period, divide the estimate total units in the allocation base for the coming period. Now, we'll see the total examples. We're assuming our company has estimated total manufacturing overhead cost for the period 630,000, and had estimated that the total direct labor hours for the period were going to be 28,000 hours. So we're going to calculate our predetermined overhead rate. We use 630 divided by 28. Okay? So direct labor hour will be our cost driver. And then your predetermined overhead rate will be $22.50 per direct labor hour. So watch out for it. So this is the basic calculation when you do the predetermined rate. We also have 16, 17, yeah. So this is the one. Based on the estimate is the determined before the period begins. So we predetermine it, right? Before the actual hours actually happened. And then we times the actual activities. The actual amount of the allocation basis, such as units produced, direct labor hours, or machine hours incurred during the period. So like the last examples we'll be using, we have $22.50 per direct labor hours. That is estimate amount. Then when you go apply those overhead costs into the real job, you need to know the actual direct labor hours has occurred by finish that job. Then you use the rate times the actual activity. That is the overhead applied. And now, so why applied overhead cost? Not actual overhead costs are preferred in the costing system. The predetermined overhead rates that relies on estimate data are often used because the actual overhead costs for the period are not known until the end of the period, thus inhibiting the ability to estimate job costs during the period. Actual overhead costs can fluctuate seasonally, thus misleading the decision makers and simplify the record keeping. Okay. So I wanted to explain the importance of our overhead allocation basis when allocating overhead costs to products and services. Predetermined overhead rates are calculated using a 3-step process. If you can take a note on that. The 3 steps, the first step, we need to estimate the level of production for a period. The second step, we need to estimate the total amount of the allocation base in the denominator that will be required for that level of production. The third step, to estimate the total manufacturing overhead cost in the numerator that will be incurred for the estimated amount of the allocation base. Ideally, the allocation base should be the cost driver of the overhead costs. That is the conclusion for the examples we just showed. Okay. So that is the importance of overhead allocation basis when we need to allocate the overhead costs. Now, the next one is talking about journal entry preparation to record the cost incurred over a specific period of operations. And also we're going to talk about a T account later. So this is the examples for raw material purchase. The purchase and issue of raw materials. In T account for, you have learned this from your financial accounting, right? The T account for, the cost of the raw material purchases is debit. When you purchase the raw materials, is debit your raw materials. The credit side of transaction will be account payable. So the cost of direct material requisition is debit to work in process and add to the job cost sheet. The cost of indirect material requisition is debit to the manufacturing overhead. So I'll quickly show there. So this is general entry when you just use your money to purchase the raw materials, and then the raw materials including indirect and direct. Okay. So the raw materials can be used either direct or indirect, and then the direct will go to job cost sheets. Indirect will go to manufacturing overhead account. See, so this is just we'll talk about it. So direct materials will go to work in process. So we debit work in process, and then our indirect will go to manufacturing overhead. We debit manufacturing overhead, credit the raw materials as in total. Then this is the cost flow. You can see they give you a calculation actually. So the total material requisition for is $52,000. And then 50 will go to work in process. 2,000 will go to manufacturing overhead. Okay. Now we talk about the labor cost. An employee's time may be either direct or indirect as well. So you from your employee time tickets, you will see direct labor will go to job cost sheets, indirect will go to manufacturing overhead account. Then we come to the journal entry. In T account, the direct labor costs are debit to work in process and added to the job cost sheets. Indirect labor costs are debit to manufacturing overhead, the same. And then we credit salaries and wage payable. So that's just the journal entries on that. And next one, we'll see the job order costing documents flow to summarize the overhead incurred. That is the journal entry we just walked through. So material requisitions, indirect materials go to manufacturing overhead account. Employee time tickets, indirect labor hours will go to the manufacturing overhead account. And then the other overhead charges will go to the manufacturing overhead account. Okay. Now, the actual overhead incurred. So we will see that if the actual manufacturing overhead cost incurred from the T account form, the manufacturing overhead costs are debit to manufacturing overhead. And then the credit side of the entry is a various liability account. For example, account payable, property tax payable, prepaid assets account, like prepaid insurance, or a contract assets account, like accumulated depreciation. So that is the journal entries as well. Debit manufacturing overhead and credit various account as shown. Now we are going to go to manufacturing overhead account, apply the real overhead cost incurred. So we have examples right there. Working process is increased when manufacturing overhead is applied to the job. So we're assuming that predetermined overhead rate is $6 per machine hour. The machine hours used for job A is 10,000 hours. Machine hours used for job B is 5,000 hours. Now we need to calculate the manufacturing overhead, right? We're using the total hours times the rate. Then we have $90,000. So $90,000 is a manufacturing overhead. So we debit our work in process and credit manufacturing overhead. So it's $90,000. Now we have our rate and we have our overhead cost. It's $90,000. But when you go to the real calculation, you will find it out that the real overhead cost is $95,000. So it's more than the $90,000 we were estimated. Then it's giving a $5,000 balance for under the manufacturing overhead. This $5,000 is under applied overhead. We're going to talk about this later. Because when we see this, sometimes students have difficulty understanding that to use the manufacturing overhead as a clearing account if there's a balance. So it's on clearing. So we need to clear out, right? Then, we haven't go to the clear account yet. So we'll still finish this examples then. Now we can see that we have our estimate is $90,000, but our actual happen is $95,000. So which leaves a balance of $5,000 with the unapplied overhead. Then we goes to each job A. We know that we have 6 predetermined rate, and then the total hours will be 10,000, right, for job A. Yeah, so 10,000 machine hours. So we use 10,000 times 6. This is manufacturing overhead. This is the balance and direct material, direct labors. It gives you the total amount. The same calculation applied to the job B. Now, assuming job A is considered completed, so it's all down. the total cost assigned to job A is $158,000 to complete the 10,000 units. So we know that $158,000 is the estimated we assign to the job A. Then when this A job has been finished, we transfer our working process into the finished good, right? So your cost of goods manufactured is transferred to the finished good. Then if it goes recorded under journal entry, you will see we debit finished good and credit working process because those are completed and ready to sell. Now, assuming further that 750 units are sold for $225,000 on account. When finished goods are sold, 2 entries are required. So the first entry we need to go is we debit account receivable and credit sales. And in the other journal entries, we need to record the cost of goods sold and reduce the finished goods. So we have debit our cost of goods sold and credit finished goods. So that is how the T account or journal entry works to show the flow of cost in a job ordering costing system. Then this is the general models of the cost flow. This is just summarized all we have just talked about it from the raw material till the end of the finished good. Now we can quickly take a look at this. So for raw materials, we debit for the cost of material purchased and credit for direct material added to working process, credit for indirect material added to manufacturing overhead. And then the materials goes to, and then what goes to direct labors, we credit for direct labor applied to working process and credit for indirect labors to manufacturing overhead. And then all those move on to the working process with debit for the cost of direct material, direct labor, and manufacturing overhead applied, and credit for cost of goods manufactured. When the working process is finished, we transfer the cost of goods manufactured into the cost of goods sold. So we debit cost of goods manufactured, credit cost of goods sold. So this is the whole general process to show how you're gonna do the journal entry and do the T account. And the manufacturing overhead, we just talked about it, is a little bit differences, is under applied overhead cost and over applied overhead costs. Okay, we're talking about this in a bit. So we move on. So this is the under and over applied overhead. But before we move on to this turn, I wanted to, as a concluding thoughts for the cost of flow, all inventory accounts are governed by the same logic. We mentioned that logic yesterday. It's always starting with beginning inventory plus addition, right? Minus the ending inventory equals transfer out. So in the case of raw materials, transfer out consists of both direct and indirect materials requisitions. Direct material requisitions are added to the working process inventory. Indirect materials requisitions are debit to manufacturing overhead. Then we credit raw material, right? So addition to working process consists of direct material requisition, direct labors, and overhead applied. Transfer out of working process consists of costs transferred to finished goods. Transfer out of finished goods consists of cost of goods sold. So that is the whole summarized for this picture. Okay, it's just following the same magic, the same logic that we just talked about yesterday. So if you still get confused a little bit, send me an email so we can talk about a little bit more. Then we'll talk about computed under or over applied overhead costs. Computing under applied or over applied, the examples we had just shown. As you can see that the estimated overhead amount is $90,000, but the actual happened overhead amount is $95,000. So which leaves under applied overhead costs. So we're going to take a look at it. The under applied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the year. So the estimated amount is less than the actual amount. and vice versa. If the predetermined estimated amount is greater than the actual amount, we call it over applied. Okay, so if it's under applied, the cost of goods sold will be increased. If it's over applied, the cost of goods sold is decreased. Okay, so that's the differences between the overhead cost applied to work in process and the actual overhead cost of a period is termed either under applied or over applied. Now, why these cost of goods sold will make the differences? Because the net incomes will be affected, and you will see there are some examples we'll show you. Now, the $5,000, remember the examples we just mentioned before, the $5,000 could be allocated to this account, work in process, finished goods, or cost of goods sold. Or very simplest, we just directly apply the $5,000 to the clearing account into cost of goods sold. Why there's differences? Why sometimes we just put it into cost of goods sold, but the others we put into different accounts. There you go. Clearing account. Yeah. So allocate across cost of goods sold and other inventory account is because the amount of under or over applied overhead is considered material. So if there's materially included, we clearing this account into 3 different cost of goods sold, finished goods inventory, or work in process inventory. But if it's non-materially, we directly allocate it to the cost of goods sold. So we have the $5,000 as credit manufacturing overhead and debit into cost of goods sold. Okay, sometimes students have difficulty understanding the use of manufacturing overhead as a clearing account. The purpose of the clearing account is to find any discrepancy that exists between the amount of overhead applied to inventory and the amount of overhead actually incurred. Actual overhead incurred is debit to the account. Overhead applied to inventory using the predetermined rate is credit to the account. So that is shows right there, the example. Now we're going to go to examples. Overhead application examples. Renovation 1, that's this company. Renovation 1's actual overhead for the year was $650,000 for a total of 27,000 direct labor hour. So direct labor hour is our cost driver. How much total overhead was applied to Renovation 1's job during the year? Right, we just totally directly made a calculation. Use $650,000 divided by 27 direct labor hour. So give you 22.5 as a predetermined overhead rate. Now, the Renovation 1's actual overhead for the year was $600,000 for a total of 27,000 direct labor hour. How much total overhead was applied to the Renovation 1's job during the year? We used the 22.50 as a rate times the actual direct labor hour. That will give you $607,500, right, as an overhead a cost applied to the job. But when you do the comparing, see the actual overhead cost is $600,000, and then you have the over applied overhead for the year by $7,500. What will Renovation 1 do? We have to write off. Okay? So when we do the write off, we have just learned the clearing account. We just quickly 750 goes to the cost of goods sold. So we go credit $7,500. That's you write off the total over applied overhead rates. Now we're going to go quickly check questions. If you could give me the answer. What effect will the over applied overhead have on Renovation 1's cost of goods sold? A, cost of goods sold will increase, cost of goods sold will be unaffected, cost of goods sold will decrease.
Increase.
Cost of goods sold will decrease, right? Because it's over applied. So we go credit the cost of goods sold. So that's why the cost of goods sold will decrease with over applied overhead costs. And then what effect will the over applied overhead has on renovation one's net income? Cost of goods sold will decrease, then your net income will increase. So we have this definitions. You go, if you want to show how much is the net income, you start with sales. Okay, you deduct your cost of goods sold, which is give you a gross margin, and then you deduct the operating expenses. So if the cost of goods sold increases and with the sales no change, your net income will increase. So that is the logic. Now, in the preceding examples, there remains a balance in the manufacturing overhead rate. So that is clearance we just talked about. So far, we have assumed that there is a single predetermined overhead rate for the whole company. This is called a plant-wide overhead rate. But in large companies, there might be different, multiple predetermined overhead rate. So each department will usually have its own overhead rate. And where's my notes? Or considered to be more accurate compared to the plant-wide overhead rate. Overhead rate is applied in each department according to its own overhead rate as a job proceeding through the department. So in the multiple predetermined overhead rate system, each department will usually have a different overhead rate. Such a system were more complex to do the calculation because each department has to do their own calculation, right? Is considered to be more accurate since it can reflect differences in how overhead costs are incurred across the department. So this is the multiple determined. So we are almost finished talking about the predetermined rate. I want you to understand that factory overhead must be estimated at the beginning of the production period. Therefore, there are most likely to be differences between actual and applied, right? So a debit balance in the manufacturing overhead account indicates more overhead has been incurred that has been applied to inventory, and overhead is underapplied. A credit balance indicates more overhead has been applied than has been incurred, and overhead is overapplied. So it's kind of a little bit tricky, but when you go through the examples in your textbooks, you should be getting it. Okay. Now, even though we do not have more slices to talk about non-manufacturing costs, I just want to quickly go through it. Accounting for non-manufacturing costs, the product cost is including, we have learned these terms, product costs, right? It's all costs that are involved in acquiring or making the product. The period cost is all selling and admin costs. That's from chapter 2. So since the period costs are not directly related to the actual manufacturing of the products, they are expensed as incurred. So companies that use job order cost system to assign manufacturing costs to products also incurred non-manufacturing costs. Non-manufacturing costs should not go into the manufacturing overhead account. Non-manufacturing costs are not assigned to individual job. Rather, they're expensed in the period incurred. For example, the salary expenses for employees that work in the selling or admin are expensed in the period incurred. Advertising expenses are expenses in the period incurred as well. Then the last, we mentioned job order cost in the service company. We have example like the law firms, right? Although our attention has focused on manufacturing application, it also used in service industry, for example, in a law firm, we talked about at the very beginning. Each client represents a job. Legal firm and similar inputs represent a direct materials. The time expended by attorneys represent direct labor. The cost of secretary, the clerks, the renting, depreciation, and so forth represent the overhead. So very similar to the manufacturing, as just a different subject. So that is basically our chapter 3. As you can see that the most important part is the predetermined rate. I got a lot of questions regarding that and how to calculate it, how to do the calculation. So we just basically go through the question, the examples, and also the slides. If you ever have any question, just let me know.